Looking for the market low in October and to start the rally out of the market depths. We're discussing what to trade and when to look for it with Gary Glover from Novus Capital. Good morning, Gary. How are you?
Yeah, I'm good, Chris. Yeah.
It's a bright morning to wake up with a huge rally in the US markets last night and in a window, but we'll get to that in a second. Let's discuss the indices that are sort of the overarching theme, because that's kind of where the crux is. If we look at the NASDAQ and the indices, it looks like it's come down to retest those lows, knowing that this report was written on Monday and the rally that we see today on the Aussie reflects the US. How's that kind of looking, whether it's the window you were after between the 4th and the 10th? How does all that play out?
Yeah, so that so the index hasn't come to a new low. I think it's come within a few points. So I think so it was a low 10.565 previously. What do we get down to? 10.572. So within 7 points of the previous low there. So pretty close there. I would like to see a marginal new low. But yeah, so look, there's a chance there that because really our timing really is for the first week of October would be our preferred time for a low. That's usually sort of when a lot of them sort of come in sort of seasonally. So whether that's sort of October, sort of the 4th sort of through to, 4th, 5th, or 6th, or whether it drags out to the 10th, I'm not sure there, but we're pretty close here. So that's the reality, is that we could be kind of near, here. So yeah, I still prefer. I thought this might sort of square out around 10,200 would be a good sort of good level to sort of come back down to. Obviously, the previous high there is around, I think it's 98.50, something like that. That's another level to keep an eye on there. But we're definitely close. We're right in the, we're bang in the right sort of time frame here. So in the first week of October here. So I had a bit of a move last night. So it looks like a big number there. It doesn't look as big on the chart when you sort of see, probably because we're finished on the low pretty deep the previous day, and then we've had a decent up day. Looks pretty big in percentage terms, but because we've had pretty wide ranges here on most of the indices, it doesn't look that announced there. But no doubt we're pretty close here. I think we're pretty close in the window here. So yeah, I've sort of been taking my shorts off there. I'll probably take the rest of my shorts off today here, and then just sort of trying to concentrate on longs here. So just start to tiptoe in. So I just sort of think maybe I might sort of try and average in here over the next sort of maybe the 4 days. So maybe look at 25% a day or something like that, just sort of tiptoe in. But yeah, I think we're just feels like we're pretty close here. We're right on the timing. Just price would have been nice to sort of see something a little bit deeper. Probably 10.2 was sort of what I was hoping for, but sometimes they just might come back to a marginal low. The only beauty there is we've sort of bounced off the low, sort of within 7 points here. So maybe we'll go a little lower first. But yeah, sometimes hanging on, everyone's probably hanging on here. There's a lot of cash on the sideline, so sometimes the market can just bounce like this and just keep going here. And that's so that's my sort of concern here. So rather than sort of hang out for I think if it goes lower, it's only going to go sort of slightly lower, I think, Chris. So yeah, we should really be looking to sort of try and take our shorts off, and we should be starting to sort of build some longs here.
Nice. Well, if we you talked about some levels there in the NASDAQ. If we have a look on the chart with the S&P 500, it seems as though for some time now we've been talking about two levels that are a bit like magnets drawing the price in. And one was that 50% fib retracement, and the other was those 2020 highs before the COVID movement. So is that the same kind of thing? We didn't quite get there. It's possible, but it's almost near enough.
Yeah, it's a bit like that. Yeah, no, exactly. So it has gone to a new low, so which is what we want to see. So yeah, I thought maybe the 50% of the range was probably the level to watch out for. The old high maybe a little too obvious, but yeah, so around what 35.08 or 35.07 or something would be. But yeah, we haven't quite gotten down here. So sometimes they don't get to your perfect levels. Everyone's sort of sitting there waiting for them, so they mightn't get there. So yeah, like I'll say, like I probably will get rid of my shorts today, and then just start to sort of tiptoe in here with a few longs here. So ideally, we'd like to see slightly lower, but sometimes it might come here sort of all that. Look at all our oversold readings are all well, typically of these sort of big market bottoms as well. So they're all showing sort of very oversold conditions there. So just got to be, can't say got to be cautious. You probably got to start sort of, I think we're going to sort of start kind of wading in here, start adding a few longs here.
Well, that's where we come to the Aussie market, because that's where our attention's more likely focused and what the trading hours that we work with. If we're looking at the Aussie here, you've been saying for some time the miners are kind of a concern, and we'll get to it in a second as to how and why they've jumped as well with the dollar. But we've had the miners and the banks and a lot of the market jump pretty heftily today. Would you be looking for them still to be less alluring and less attractive in this cycle?
Yeah, that's exactly right, Chris. So I mean, previous sort of cycles, sort of similar lists have sort of shown that I mean, we have bounced with the US, but we've bounced to sort of in the early stages in a much duller manner, and we've actually oftentimes we've revisited the low and actually moved to new lows in the next sort of 1 to sort of 3 or 4 months. So there's some good reasons as to why we might actually I think the commodities just that business cycle really, it's just it's bonds first and equities second and commodities third, and that's exactly, I mean, the bonds have been going for 2 years, equities 1 year. I mean, commodities are only been coming off for 4 months here, so that's still pretty early here. So that's the way it normally unwinds here. So the charts are sort of showing that as well. So history is sort of showing that. So far, I just got to follow, all these sort of normal cycles have sort of played out correctly there, and we've seen pretty aggressive selling all the way down here too. All the volume on the XJO there too, some pretty heavy sort of selling there. So yeah, we might get a bit of a bounce here at the obvious level, but it could be dull here like that 2002 market, and then come back a bit lower here. So yeah, I'm probably just I'm staying away from commodities, just looking at quality industrials, and I'm looking at US exposure as well. I actually want to be long some sort of US LICs, sort of managed funds, so yeah.
We've got that list at the end of the report that we'll quickly touch on, knowing it's a busy day, you've got to get a few orders on.
Yeah.
The Dow Jones, the weekly chart, just touching on this 60-year cycle, because that's been the one, as you note here, it's been bang on. You did really well in June, picked that turning point, load back the truck up, and as you said, look for your shopping list, get ready with the week ahead, and then got long, sold off into the mid-August high, got short, read that well, and then you've been riding, and as you're saying today, you take the final bits of those shorts off, even though you've taken profits in the last couple of interviews. You've just talked about that. Is this still playing, the script still coming out, even though the timing, like how does this, you've got the 5th to the 6th, or maybe the 10th to the 19th. Is this all kind of still to script somewhere in here?
Yeah, look, we're pretty close here. So again, we've it's funny how the Dow and the S&P have both moved to clear new lows, yet the NASDAQ hasn't. And this is a growth crunch. So again, actually the NASDAQ, which has been the weakest index, is actually showing a little bit of relative strength here at the very end of this bear market. So that's a bit of a lead here that technology there might be the sector to watch here, Chris. So but yeah, ideally I would have loved to have seen something around 28,000 on that on the Dow Jones. I think it's only got back to what 28.7 or something like that. So so it's gotten close here, but probably oftentimes we'd like to see perfect sort of lows here, and technically, and big levels and things like that. So but we have moved to a new low here. So again, look, maybe we'll bounce for a day, come back and retest a bit more here, but we're very late stage here as well. So just again, I just sort of feel like it's sort of sometimes you can be I'm guilty of this, is trying to be too exact and too cute here, looking at the dates and stuff there. And look, we got the perfect top in August, right on our date. But trying to be over cute here on these lows as well can be, that's why sometimes you just sort of stagger out. That's why I sold a little bit of my shorts, maybe a little bit early there, just in case. And I'll probably just exit my shorts today, just in case as well. As we don't sort of see lower levels, even though I think they should square it slightly a bit lower here, but sometimes they don't come. So, we've got to wade in. So I'll be probably putting I'll definitely be sort of just getting a few little longs here, get some action going here. Just feel like you've got to sort of start adding to the portfolio here. So, I'll be busy today, sort of adding a few small positions there, just because I think you sort of have to sort of tiptoe in here now.
Well, you've mentioned that the commodities and the US has been stronger, and that's where you're looking to focus your attention. If we look at the US dollar chart that you've put in this week's report, and we look at the accelerating trend that you've spoken about many times before, could this climactic top be an important part of the turning, not only for the US markets bottoming, but also the commodity cycle that's been beneficial to the Aussie market?
Yeah, no, exactly, Chris. You've nailed it there. So, I mean, this has been running for a long time. The US dollar, like a lot of the trades, are sort of built around, the US dollar strength. And so we've seen some of the other currencies, obviously like the British pound stuff, get absolutely hammered and get annihilated last week. But we saw some big wide ranges and some big reversals there. So that US market, which has been running for quite some time here, so that's a couple of years of currency going up. So, I mean, currencies are fairly sort of flattish behavior normally. So you don't get these sort of vertical trends too often here. So we've definitely got this aggressive there. Got a massive sort of shooting star, exhaustive sort of style reversal there last week. So interesting here that this might be coinciding with some bottom in equities. So if oftentimes these turning points, quite a few of the instruments might turn all together. So I just think it's really interesting here that that the US dollar is showing exhaustive behavior here, right at the same time as the equities might be finding a low here. So that's something that does happen in the past a bit here. So I just thought it was pretty interesting here that had a massive reversal there and a big wide range, and that was all the activity and all the other, a lot of the foreign currencies were getting hammered there last week, really sort of selling up super aggressively, which is sort of like late stage for them as well. So so just kind of definitely supports a reversal in equities here, and a change in trend possibly for a lot of these assets.
So just to extrapolate on that for a second, for the Aussie market, when we have the rising US dollar, the Australian companies earn in US dollars, but when they convert them back to Aussie dollars, that can be a larger earning for Australian shareholders and larger dividends. Can that be part of the reason that share prices stay higher?
Yeah, it can be. I mean, it just a lot of the asset classes, like typically, obviously, some commodities don't tend to. I mean, like obviously, gold is sort of one that comes to mind here. Obviously, it's been US dollar's been strong, so oftentimes when the US dollar is pretty strong, commodities are pretty weak. But obviously, this has been a little bit different in terms of in terms of what's happening sort of globally with supply chain issues, things like that. But yeah, it's sort of. I just sort of find sometimes these sort of bigger moves in these markets here. This is an incredibly large move for a currency. They just often, some of the major indices, they just tend to find peaks and troughs at sort of similar time. So while this US dollar, I mean, the US dollar going up so aggressively should be pretty negative for US. Obviously makes them
more expensive.
Yeah, it's more expensive to come into. So no one's going to want to sort of deal into the States, in the US. But if it starts reversing, coming off, that should be good for equities there. So it's a bit like inflation sort of coming off. It's good for equities as well. So all these different asset classes are all good, bad for for other assets. But it's probably more the fact that this has been running for 2 years, and it just looks like it. All these other currencies have been absolutely pounded into sort of obliteration in the other way. So this might just be a change of trend in a lot of those things. So actually I haven't looked at gold here, but probably should be looking at gold here as well at the moment. It's been definitely one of the most unloved commodities there. So if that US dollar is going to turn here, we should start to see some support come in there. So yeah, interesting.
Maybe we'll check that one soon. To round this out, no, it's a busy day. We've got some orders to put on, and you've got a short list of companies that you've mentioned in the report, and you'll probably narrow that down. So you'll be on the phone talking to clients that you're putting trades on for today, probably narrow that list. Just run us through quickly, what are these types of exposures as a whole? What are these tickers getting you exposure to, and why have you picked this group of companies, this type of company?
Yeah, so as I sort of highlighted there last week, the Aussie market might underperform here for the next few months there. In the previous sort of cycles, we've underperformed the US market. And that's because the commodity cycle is often a laggard. In previous cycles, like I think 2002 low, and then I think even 92 low as well. Basically, the All Ordinaries, or the XJO found a low like a month or two later, or a few months later sometimes, while the US market went up pretty aggressively. And that was almost technology driven as well. A lot of those rallies were were technology growth crunches, and then technology bounced, and then commodities lagged, and then our market we had a bounce, but probably timid. And we moved to new lows in quite a few of those cases here. So just indicates to me that commodities could have more downside here, and the similar cycles of the past have shown that we've underperformed. So yeah, my cycles are suggesting we should be long some US equity. So I've gone through, and those are a lot of the US based LICs, ETFs. I personally prefer closed funds over the ETFs. I just don't think it always, people think ETFs are pretty safe here, and they might be safe there, but ETFs are not closed. They're basically open. So as more money comes into it, more money gets pumped into them, and then they've got to buy the same shares, push them up, and then so it does actually affect their performance. If you overlay any ETF over the instrument, I find you don't get exactly what you actually think you're getting in there all the time. There's a discrepancy there. You just go and look at a B-bus versus a G-gus, or a long NAS versus the short NAS. They don't, if they're basically they're the inverse of each other, the performance should match each other identically if you had them both at the same time, but you'll find that they don't exactly. They'll be nearish, but they fall short of actually what they say they do. So that's why I just don't love ETFs. And yeah, a lot of the ETFs, I think there's a stat there, Chris, something like, might be something like 80% of ETFs that get that are sector specific ETFs don't make money in the next 12 months after they first get issued, because normally they get issued on a hot theme, and then that thing goes cold, and when everyone jumps in, it's so I just found that I prefer the closed funds. Basically for one, they got to there's no more money coming in out of there, so it's a closed book. They usually have to basically declare what they've invested in, so you can see what shares they're in every week, and they have to put their NTA out every week. What regulations are around ETFs?
Well, there's a lot of slippage and a lot of questions.
Exactly,
mate. Questions there.
Mate, I've worked on the institutional side of things. I worked on warrant desks before and stuff there. Mate, if Wall Street and Main Street can scalp a little bit, make a little bit on the side there, mate. Unless there's really, really strict parameters in place, So just ETFs can still work. I mean, they still move, and obviously you get, they get your exposure in certain areas you can't otherwise get into. So I will use them if I can't get into something else, or if it's really specific on something I really want. But if I can find a closed fund, which is almost the same, I'll go for that 9 times out of 10.
Right. Well, that's a good way to summarize those companies that you've got there, and all in with what you were saying, US exposure, a bit of technology. They're the reasons why. So got a busy day ahead, a lot of orders to put on. So we thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
To look at the Gary's playlist with these other reports and weekly reports, you can click on the right-hand side there. And then also to understand some of the trading strategies, you can click on the right-hand side for a more in-depth one.